Good afternoon, notaries. Thanks for joining us on your lunch hour. Welcome. And thanks to RBC, we have Jared, Brandon, and Cam joining us today. Notaries, this is the first year RBC is one of our annual sponsors. So super excited to have them on board, and they'll be at our conference this year in April at the Vancouver Marriott Pinnacle, and registration is open now, notaries, for that if you haven't seen that yet. So hope to see you all there in person this year. Housekeeping notes, Q&A, the Q&A box is open, so just pop your questions in there at any point and we'll address those questions throughout the presentation. And I wanted to start by introducing Cam. So Cam Rahman is Vice President, RBC Commercial Financial Services, leading a team of relationship managers and directors specializing in public sector, nonprofit, and business professional services in British Columbia. So I'll pass it over to you, Cam, to get us started. Thank you.
Thank you, Trista. It's our pleasure to join the conference this year. We are looking forward to meeting each of you in person as well. We're hoping that you find the insights shared in today's session helpful as you navigate the investment and economic landscape in 2025. It's my pleasure to introduce our speakers, Jared and Brandon Kerwin. Each of them brings over 20 years of experience to their investment advisor roles at RBC Dominion Securities. Jared's got a proven track record of delivering tailored investment strategies and practical solutions to meet clients' goals. His expertise spans risk management, equity markets, and advanced financial planning for professionals and for business owners. Brandon is a seasoned advisor with extensive experience in portfolio optimization. He specializes in combining advanced analytics with customized investment strategies. His focus on equity market trends and risk management empowers clients to confidently navigate complex market conditions. So over to you both.
Thank you, Cam. Thanks, Trista. We really appreciate the opportunity to be here and also to update your members on a lot of the economic events and investment changes they can expect for this year. Obviously, it's been a pretty big week with the new the new party and the potential of tariffs, but we wanted to discuss a lot of the economic update first and then go into the investment update and then much more about your business analytics and potential opportunities there. So just to get it started, I will likely start with the economic update, but wanted to leave it to Jared as well.
Yeah, thank you for joining us and for the opportunity. We're really excited to get started. Obviously, it's been a lot over the last little bit, and luckily we just got an update from our chief economist on the economic update piece. So Brandon will start with that in the slides now, and then we can get into the investment piece.
So thanks very much for joining us. And Jared and I are out of the Vancouver RBC Dominion Securities office as well. We're identical twins, and we've kind of worked at RBC, but also TD prior to that. We're investment advisors, and we help corporate clients and personal clients, and also foundations and charities too. So just wanted to let you know a little bit about what we do. We have an investment committee at RBC that's comprised of senior economists, portfolio strategists, and research analysts. And they also give recommendations to advisors and clients and the community at large. In terms of the right asset mix for stocks, bonds, cash, and obviously just depends given the year that's upcoming. We wanted to also mention that we run a number of models for our high net worth clients and kind of help them with a sort of North American focus. That can include managed or non-discretionary managed assets as well. We use partners such as BlackRock iShares, Vanguard, JP Morgan, Goldman Sachs, and have many institutional wealth offerings available to our clients. So just wanted to kind of go over some of those at the very end of the presentation, but in the short term, because of the economic update with regards to monetary policy, we'll be talking a lot about the economic outlook at the moment. So we just had Robert Hogue, our assistant chief economist, out last week for a business owner planning event. These are his slides. Hopefully some of you were able to attend that, but it hopefully will give you a good outlook as to what things look like if there were changes that occurred with the new tariffs and what it would look like if there aren't. But also just to kind of give you a firm understanding of where Canada is and the US is relative to each other and economically, especially given the changes that have occurred. This was the first slide that he showed, which is essentially showing that in the bottom right, if they increase tariffs to where they're talking about, it would be kind of like they did back before the Great Depression occurred. So this seems to be something that indicates that they're posturing to some degree, or that there may be material changes that occur if those did go through. I think the US has clarified since then that Canada misunderstood and that it was not a potential trade war, but rather you know, a way to get things on side border wise and with his policies, it sounds like. But they drew the analogy that in the old movie, Ferris Bueller basically mentioned that the Smoot-Hawley tariffs, when they kicked in before, that was the start of the Great Depression. So if you look, the line is quite similar. So that's not a great thing. Everybody knows that that occurred then too. So tariffs have the potential to seriously disrupt trade, depending on how much they increase. That's been put off for 30 days, it sounds like, at the very least. So looked like it's much more of a part for negotiations, but just wanted to let you know that it could be a material thing if it does go through. I'll kind of skip through these slides rather quickly, but if you guys have questions at the end, please let me know. I'm not an economist, but it definitely applies right now. So Canada has a trade surplus. It's tiny if you take out oil. It's actually in a deficit if you exclude energy. And so that's what this graph is showing. So it's interesting. He's saying that he's doing it basically because, or he wants those to come through because of the imbalance. But if you look at it, if you take out oil, that's actually a negative for Canada. There's a massive deficit, obviously is still a tailwind in the US. The US runs roughly an 8% deficit, in Canada in the 2 to 3 range. The US federal government is currently running a $2 trillion deficit at the moment. If you look, Canada's economy has fallen a bit behind. The US continues to outpace the Canadian economy, and also globally. It continues to outpace a lot of countries, particularly in the G7. And yeah, obviously it's showing that top income earners here in Canada are doing well, but others are not, with the high debt to GDP. If you look here, the good news is that inflation is back to target. All the central banks in Canada and the US were basically trying to get back down to the 2% range, 2 to 3%, I think most of them were saying, but it looks like that's been successful with the blunt force of monetary policy, i.e. raising interest rates. The consumer price index is back down to closer to 2 or 3% in the US and Canada. Policy interest rates. So this is just saying that the US is likely, the economists currently think that the US is likely to be done cutting rates, and that for 2025, and that Canada has 1% more to go in the next 6 months. They kind of think it will drop by 1.25 basis points, they said. Since then, they've already done 0.25. So basically it's our capital markets division is saying another 3 cuts by the middle of the year of a quarter point each to negative 0.75. So you can expect that will have implications for your clients, particularly the mortgage clients, in that if they have a variable rate mortgage, that's likely to fall 1%. If they have a fixed rate mortgage, it's probably not going to fall nearly as much, just because that's already been priced in a little bit, and because the fixed rates don't fall as much usually when that happens. So just so you know, expecting 1% by mid-year, 0.75 is what they're saying at the moment. Keep in mind, economists' predictions are not always perfect and things change too. So, but that's the current outlook, is another 1% lower for the variable rate. So if you have primes roughly 5.2 right now, so if you have a variable rate mortgage, you could expect it to fall by 4.2 or maybe slightly higher than that by mid-year. Also, I just going back to that slide, the main thing is that if you have US borrowing, it's unlikely to be cutting, is what RBC believes. So that's a pretty big difference from what I think maybe the market might believe. So also, if you have higher fixed income yields in the US, what does that do relative to Canada? So things to consider, obviously, if you're investing too. So yeah, wider spreads will likely weigh on the loonie. 69 cents is what it was forecast, but that's before the tariffs. So it's kind of in around that range now. It looks like maybe 63 cents is the lowest it could get in the near term if they did go through. In the last week, the US dollar is off actually about 1%. So not a huge change, just given the backtrack from the prior announced tariffs and then the pause for 30 days. So Canada's economy has contracted in the past 2 years on a per capita basis. This is GDP per capita, so income basically. So relative to each Canadian household. So it's basically saying that monetary policy worked. It feels like a recession, but we're not actually in a recession in Canada. Unemployment's rising, however, so that's one thing to note in the last couple of years. Canada isn't officially in a recession. As you can see, those are the forecasts. It's not forecast to go in one either, but just kind of slower growth. Our economy has stagnated the last year and essentially sub-potential growth in 2024 and 2025. So still thinking that it can grow considerably, but at the moment kind of stagnating relative to the US. Because our population has boomed, however, the last couple of years have actually kept Canada on the right side, not in a recession. Immigration wave, they added 2 million consumers to Canada in the last 2 years. So that has been unprecedented and helped obviously keep the recession at bay is what they mentioned. Immigration, so the demographic tailwind is about to shift, however. They're saying that temporary workers and other sort of student visas, etc., might be impacted. So the new targets that were put out by the government are saying essentially that they would reducing the number of net non-permanent residents in Canada. So those are like temporary workers and temporary residents, which there were serious reservations by the Economist when he spoke of this, saying how do you essentially implement such a policy? It would be very unpopular, probably, and also very difficult to do. However, just keep in mind that that's what the current outlook is saying. And if Canada just kept out of a recession because of population growth, and now they're planning to, reduce population, that could be an issue as well. So our productivity must increase. He said this chart essentially is held for 30 years of his career, and Canada's productivity has been rolling over for some time. We noticed on the chart that if you look like during the pandemic, productivity increased, but then has since been coming off. So yeah, obviously stuck in a low growth environment, and a lot of that has to do with IT and infrastructure spend that they believe must occur, and in order for workers to become more efficient and also to create new markets that would help Canada. So the BC outlook actually improved slightly from an economic standpoint. Interest rate cuts will boost household spending, which they think would new energy and exports would also help, but there's not a lot of energy projects that are left to continue, is what it sounded like, other than LNG, which was a bright spot. It says natural gas exports in BC in particular will also support increased energy production in the province. So that'll be really positive, it sounds like, for Canada to come, particularly for BC. This just says that home resales, obviously there's lower rates would help housing demand and kind of alleviate the consumers' short-term constraints. But essentially the supply issue is still, and the affordability issue is still an overhang. So that will restrict buyers' abilities to bid up prices in the near term. So it's very unaffordable to own a home in BC from the looks of this chart. It's also saying that if interest rates go lower, then that will help them shorter term, however. Price is likely to appreciate slowly overall. So this is kind of the forecast for the housing market, just so you can see what they're anticipating. It's not negative, but it's slower growth. And this just shows housing starts. So obviously you guys are in the real estate and wills and estates sectors, it sounds like. And essentially residential construction is expected to ease slightly. So that's sort of a negative. Earlier interest rate spikes has dampened pre-construction sales. That's just so you know, there's a bit of a headwind if population growth rolls over. BC will be highly sensitive to immigration cuts. It's also been a huge beneficiary of the immigration that's occurred. So if you need more information on what our economists think, this is where you can go to get that. We think it would be very helpful if you're trying to get some insights as to how you could apply it to your business or going forward over the next year or two. Yeah, and I'll leave this to Jared's part. I think he's going to discuss sort of how we can help, and also a bit of the investment outlook.
Thank you. Thanks for the economic outlook. As far as the investment outlook goes, at RBC, we have access to many different areas. We're part of the Dominion Securities Group, which is the wealth management arm. And there's several different areas, commercial markets that Cam is part of, as well as capital markets and other ones that are kind of complementary and supporting. And then there's the retail bank side of things. Within RBC Dominion Securities, we have pretty specific access to ultra high net worth tools and teams. So you're able to access different analytics and software. We use a planning software called MyGPS. Brandon and I switched over from a large bank in Canada and a few years ago, and one of the reasons was because of this MyGPS tool. It's a great way for clients to be able to see all of their financial planning and be able to see all of their opportunities and constraints. And they also have a Compass planning piece that is part of that software. We find AI and data and software being kind of the growth engine forward for companies, as well as for just every industry. So RBC has been using that for over 25 years in different capacities and different teams. We also have access to a financial advisory services team and high net worth planning team. They're great for if there's ever any questions that clients have that come up. We're able to kind of get an answer within 10 to 15 minutes on really complex things. Obviously, you guys probably deal with those daily on very high levels, but our team can certainly support with being able to explain and show it to clients. So we also have a private trading office and a family office services for investors. We find that they're very helpful, especially with the changes with capital gains possibilities, as well as like any will and estate changes that are planned for trusts. Private banking is great for being able to provide access to different financing and different rates or better rates on both sides of debt and credit. And then we are able to use our RBC Global Asset Managers, and they're the ones who usually provide guidance on which specific sectors and assets they think will outperform when it comes to asset mixes and asset allocations for the years. So with those groups, we've found it's been very helpful for being able to try to navigate markets. Obviously, there's some geopolitical risks, as Brandon alluded to, and that's probably the main theme for 2025. Obviously, with the new administration taking over, currently there looks to be a break between what the Federal Reserve is doing with interest rates staying where they are and forecasted to stay where they are, whereas every other central bank and every other economy seems to be lowering rates. So that's a very interesting time. It's also it comes at a time when bonds and equities in the US particularly have both appreciated. You don't always see where bonds go up and equities go up together. Usually in the past, there's been they've been counter each other. So it's very interesting to see that things move together now, and that they can. Obviously, different teams internally have debates on whether or not that's sustainable. Equity markets tend to follow earnings per share over time. Obviously, there can be distortions. We found that the breadth and expansion within the equity markets have been very lock in step. So you've been able to see that every quarter and even monthly inflows actually into the S&P, for example, have been growing since 2022. And we've been carefully watching to see, you know, how that's affected this earnings period, which is just started basically, and it looks like it's been holding up quite well. Last year, earnings really did outperform. Usually, when companies guide to earnings, there's a multiple that is expected to not take place in the earnings events, and usually it's by about 5% under what is stated. Last year in the US for the S&P, they actually hit that target, and the earnings per share, there was no lowering of the percentage. So this year, obviously, it'll be interesting to see if that can be maintained. But some examples of like people that we work with are willing estate clients, and using My GPS, we can also help with different law firms and being able to provide specialized information and loans to partners and things like that. But also doctors and cardiologists, and depending on, you know, what's needed. But those are just for individual clients. We see that rates, particularly on the fixed income side for this year, US yields will be higher, Canadian international will be lower. Obviously, we're seeing the strengthening of the US dollar for this past couple quarters, and possibly into the future. It seems to be very hawkish in terms of the decisions that are being made to strengthen the dollar, and therefore, you know, not doing rate cuts. We see in Canada that the rates have just been lowered. 3 to 4% seems to be a realistic fixed income return, either in ISAs, which are investment savings accounts, or bonds. GICs and commercial accounts actually have an amazing account called an ADI account, automated deposit interest account, which is a way that you can get daily interest calculated. And those rates are also very strong compared to even like an investment savings account, which we would have access to in Canada and the US. So in Canada, it's about 3 to 4% is what you can expect. US ISAs are higher, investment savings accounts are higher, bonds are higher, GICs are higher, and the ADI account features are higher. So about 4 to 6% there. Obviously, that's quite high compared to the past. Not maybe so much the recent past, it's actually come off a little bit, but if you have the opportunity for US dollars right now, it looks like there's quite the pickup there. There is obviously risk in currency, Canadian and US disparity. It looks to be the US is currently the strength, and may continue to be for some time. It's usually there's expected to be about a 3% variance between the two. Obviously, it would be much worse with tariffs for Canada, and from what we've been reading internally, it appears that that's more a negotiation tactic. But those negotiation tactics can also have ramifications if, say, investors decide not to go to tariff-seeking sectors or tariff-seeking countries. They just decide to minimize exposure. That can also have major impacts for different countries and even corporations in that matter. So there is risk to earnings multiples being the point, but breadth so far appears to support earnings multiples right now. And so the internal teams that we've been speaking to seem to support that the equity markets in the US should do well, a variance between 12 to 15%. The options market is currently pricing in a 12% move, 12.39% move in the US, up or down. So it's worth noting that. But the earnings have been strong, and it's expected that they will still be strong according to RBC. So obviously we would want to look to the analyst target prices and then the variance of those. What seems to be consensus from the strategic asset allocations that we have in the models that are used in the US, it's saying that the average of the equity target price is to be looked at as kind of the high, and maybe not past that, given how stretched multiples are with PE ratios and things like that right now. So that's something to consider. Obviously, earnings per share is a big piece. If you look at the market incline over a long enough period, it ties directly to earnings per share increase. Obviously, there's some variance between those, like we may be seeing now, but Canada as well. Canada is about 8% is what the options market's currently pricing in, move one way or the other. Usually that is the case. S&P 500 long-term average is about 10.8 to 11%. And then we wanted to share a program that we think would be possibly a great opportunity for your members. Within RBC Dominion Securities, we have a specialized advanced data analytics team. They've actually been operating for a very long time. Around 2017, they started with their first assistance to clients, mostly foundations and corporations. But what we found is it's the biggest asset driver in being able to increase assets at RBC across the country. We've heard, particularly in the East, it's had quite the adoption recently. But we think that it, having worked with the commercial group and with different groups, to be able to work with different levels of businesses, we found that it's been really quite an opportunity to be able to use data and AI, a mix of the size of business that's trying to apply it to RBC's data. And then it's a way to kind of increase business opportunities for members. It's a great way to increase your income. If you wanted to be able to gain access to different levels of clients or be able to understand your clients more, RBC offers this service and team that is able to kind of merge your data with our data and figure out, what the best opportunities are. It's an RBCDS program, so you have to be an RBC Dominion Securities client, and then we can certainly speak to you about what that looks like. But it's about a 15-minute meeting initially with a VP named Jay. Him and his team, he has a team of 8 to 9, have been training data models and AI models for many years, and they apply it to different levels and different types of business. So we found it's been very good for people to be able to organize their marketing activities, to be able to understand key prospective clients, and then key prospective areas that they may want to grow into. And then using RBC Insights to look at different locations and where those opportunities might come from. It's also very good to be able to try and organize time and operations and be able to gain more from your existing clients or book. If there's any opportunities in there, it certainly shows. What they do is it's a service where they'll meet with you, uncover the information, try and gather your data. Everything is privacy protected, so it's all protected from your side and then protected from the bank side. And what they do is they kind of merge the information and say there's some opportunities here and there's maybe some other opportunities here, and then they'll lay it out in your demographic or in different demographics within either the province or nationally, depending on what you're looking for. And they can really pinpoint different opportunities that we've seen really changes businesses, and it takes often several meetings. It's not kind of a one and done thing, and sometimes you might want to solve for different things as they come up. So we just thought we'd introduce that program. It's not very well known in the West, but it's been very well received. So we thought it would be a good thing to share with your members. I'd be happy to have a 10 to 15-minute call with anyone if they just wanted to get more information, or if you currently have an RBC advisor or RBC Dominion Securities advisor, we'd be happy to share the information with them too after this. I think that's it. If we can turn it over to questions and answer period, we'll try and come up with the answers. Please share questions.
Great. Thanks so much, Jared and Brandon. That was excellent information very quickly. So thank you for all that. Appreciate it.
Thank you.
Notaries, any questions? If you want to just pop them into the Q&A box. Otherwise, as Jared mentioned, if you wanted to speak with them directly, they put their contact information up here for you to reach out directly. I will just leave it open for a second, but I think your presentation was very thorough and covered everything.
Thank you.
Any final words, Brandon or Jared, before I wrap it up?
From our perspective, I mean, I don't know if Cam has any that she would like to add to that. Obviously, Cam's on the commercial side, so they do a little bit different things with corporations. So, but from our end, I mean, I kind of think like S&P 500, obviously people are concerned, but pullbacks would be kind of normal and expected throughout the years on the equity side. Like that would be like a 10% draw would be a typical pullback and likely opportunity. If it's a 20% one, gets a little bit more risky, but not uncommon either. But we're kind of thinking like a 10% 3 times a year would be like a normal S&P 500 pullback. So despite like the options market's pricing in 13% upside or downside. So from now till January of next year. So that's where we've kind of based the equity component on. Yeah, in terms of partners, we also have Royal Trust, which can possibly be a source of referrals for you guys from a notary side, or we would encourage you to reach out to a Royal Trust representative in your area or to an IA who could then connect you, because they see many clients who do will and estate plans internally, and then they get referred off to either a lawyer or a notary from our perspective, from our end. So yeah, that'd be a great source of referrals. We're happy to connect you with ones in your area too, if need be, just email us. But yeah, I'll leave it over to Jared and Cam. I don't know if they have more to add.
I just had 2 points. One is the automated deposit interest account. That's just through commercial, so it's not RBCDS. But along with the analytics program, we found that program is amazing. It's something that wasn't offered at other banks. It's RBC's the leader in the space. There's billions of dollars in that program, and it's a great way if you have trust accounts to be able to gain access to kind of higher interest rates and liquidity and daily market interest changes. And there's no requirement to manage it. It's automatically done just based on your account, based on the approvals up front. So we've seen a lot of success from that. We've also seen a lot of success from the analytics program, just uncovering different opportunities. Obviously, everybody's very interested in AI these days and seeing how it can work for them. And Jay's team has been training these models for many years, and he's this. I try to get him signed up as a consultant for some of the largest corporations that we kind of come in contact with on a day-to-day basis, and he does it. So somehow him and his team get the things done, and they've been very good. But another area which isn't well known, but we should mention is hedging. We're seeing a lot of people that are concerned about having a lot of Canadian dollars or a lot of US dollars, or having very heavy concentrated equity positions. We think that there's a big opportunity right now for hedges and being able to just take some of the potential for volatility off by hedging strategies. RBC has a program called put warrants, which is a great way to hedge currency. And there's also other ways that you can do it that aren't complicated at all. But it's certainly something to look at if the tariff and other trade discussions continue. just maybe something worth mentioning to clients as well.
Thanks, Jared. Any final words from you, Cam?
Just thank you for your time today. And if there is questions later, feel free to reach out. We appreciate you spending the time with us today.
Amazing. Thanks so much. And thanks again for the sponsorship. Looking forward to working with you more, RBC. And thanks so much, notaries, for joining us. Have a good afternoon, everyone.
Thank you.
Okay.
Thank you, guys.